Good evening, friends. A warm welcome to all. Today, the webinar is on Changes in Income Tax Forms and Related Amendments for Assessment Year 2020-21. CBDT has filed notification number 31 by 2020, dated 29th May 2020, notified the new ITR forms for financial year 2019-20, assessment year 2020-21, in line with the amendments made by the Finance Act 2019. And we have a guest speaker, CA Kinjal Bhuta ji and CA Vishesh Sangoi ji. About CA Kinjal Bhuta ji, she is the managing committee member of BCAS, co-editor of BCAS Referencer and annual flagship publication of BCAS, author of book on presumptive taxation under section 44AD, 44ADA and 44AA. She is a core group committee member of Direct Taxation and Seminar and Membership Development and Human Resource and Development Committee of Bombay Chartered Accountant Society, BCAS, and about C. Vishesh Sangoiji. His areas of functional expertise include income tax, FEMA, transfer pricing regulations, and RERA regulations. He has co-authored the BCS publication on Simple Form 3CD and has been regularly contributing to BCS Referencer and BCS Budget publication. He has also authored articles for BCS Journal, CTC Journal, and CVOCA Journal. Presently, he is the convener of the Taxation Committee of Bombay Chartered Accountant Society and a member of the Study Circle Committee of CVOCA Association. He has been a member of the Direct Tax Committee of Western Indian Regional Council of Institute of Chartered Accountants of India. And we have with us none other than CA Vivek Puranaji, founder of CA Sansaar. And his name is just enough for the CAs. Now, I would request him to welcome them and give them a welcome address. So please.
Thank you very much, Stuti ji, CA Kinjal Bhuta ji, CA Vishesh Sangoi ji, CA Stuti Mahajan ji, all respected member of the profession, ladies and gentlemen. A warm welcome to all of you at today's webinar, and I hope everything is fit and fine. My sincere thanks to CA Kinjal Bhuta and CA Vishesh Sangoi ji for accepting our invitation, and warm welcome to both of you. At this today's webinar, very important webinar on the changes in income tax return forms and related amendment for the assessment year 2021. And we have already uploaded many videos. In fact, Stuti had done all these things, ITR 1, 2, 3, 4. But today, this is the exclusive webinar only for the changes, what changes in this assessment year. And Kinjal and Vishesh ji will guide us. So without taking so much time, now it's over to you, Kinjal and Vishesh. And once again, my sincere thanks to you. Thank you very much.
Thank you so much, Vivek ji. As he has rightly mentioned, that we are going to concentrate in this presentation mostly on what are the changes vis-a-vis last assessment year, and what were the amendments in the Finance Act which brought that changes in the income tax return forms. So we will take the amendments first, because understanding the amendments will gradually let us know that what are the practical changes which is being made in the income tax return forms. So me and Vishesh, we both will be leading the seminar, and I would be talking on the amendments part, whereas he will be taking us to the practical aspects and the nuances of return filing. So I'll just move on with the presentation. Okay. This is a brief synopsis of what we are covering today, as in we'll be starting right from form 26 CS, because as we know, this is the basis of matching the income or matching the tax which is deducted at source. So we'll start from whatever changes which have been made in form 26 CS. There is a lot of change which has been made because of COVID-19 situation. So we will move on to that, and then we'll talk about the amendments which were made in 3 finance acts: the Finance Act 2019, Finance Act 2019 number 2, which is the act which was passed after the election, and the Finance Act 2020. There are few changes of Finance Act 2020 also which are applicable for assessment year 2021. So we need to know those changes, and then we'll move on to the applicability of the return forms, the important changes in the forms which have been made, and at the end, to sum up, what would be the relevance of efficient reporting of income tax return filing. So straight away moving to the changes which have been made in Form 26 AS. So earlier, Form 26 AS it was not considered or not named as in a new form. So now it is the new Form 26 AS is now named as Annual Information Statement. It is guided by a new section and a new rule. So earlier we had section 203 AA, which was the guiding section of introducing the Form 26 AS, and Rule 31 AB gave it the powers to prescribe what would be the contents of Form 26 AS. Now that there has been a change with effect from 1st June 2020, so there was a notification dated 1st June which made changes in the Form 26 AS and the contents which will be displayed in the form. The earlier section of 203 AA and the earlier Rule 31 AB stands omitted, and there is a new section which was introduced in the Finance Act, Section 285 BB. This section specifies that what are the new contents of Form 26 AS, and Rule 114I. This is the rule which prescribes those changes. So one may refer to the sections or the rules in case of any issues. What are the changes which they have made as regards to the basic details? We were giving personal details like PAN number and the name of the assessee up till now, and the assessment year. Now there are additional personal details wherein we have to provide the Aadhaar number, the date of birth, the email address, and the phone number, the mobile number of the assessee. So these details are additionally to be provided. Another peculiar feature of the new Form 26 AS is that, unlike earlier where the form used to be uploaded once in a year, now it will be updated every 3 months from the end of the month in which the information is being received. So lot of information is to be portrayed in this form is the information which they receive as the specified financial transactions. So as soon as they receive, within 3 months they will update it. So it will be like a live 26 AS wherein assessee can view that whether those details, if there is a transaction made or a huge transaction based on those parameters which are specified in the section, then in that case that can be done. Another thing is that it enables the DG system, Director General, to upload the information received from any other officer, tax department, or authority under any other law. So any action also taken under any other law can be displayed under the new Form 26 AS. This is quite a change, because up till now only all those details which are pertaining to income tax were to be uploaded or given in the new Form 26 AS. Now it enables to provide other details as well, and also even the details which are received from any other department, maybe not necessarily tax department, will also be forming part of the new Form 26 AS. So let me come to what are the additional details which we are talking about. So up till now, we all know that TDS and TCS, whatever tax is deducted or collected at source, is portrayed. Now all the information which are there in the specified financial transactions, they all will be also be portrayed. So if there is any purchase or sale of property, so these are just illustrations, or any work contract, or any loan or deposit above rupees 50,000, or any investments or expenditures which are made, in that case those all details will be portrayed in this Form 26 AS. These are just few illustrations, but all transactions in the specified financial transactions will now be portrayed. So if you download Form 26 AS right now, as on today's date, then if there is any such transaction which is made, then that transactions will appear in the Form 26 AS. So one may check that. any information related to payment of taxes or payments of refunds will also be given in this. So whatever details of taxes is there, any information relating to the completed or pending income tax assessment proceedings or appeal proceedings, even till a higher level of high court or supreme court, that will also be given in this form. And any information as relating to the double taxation avoidance agreements or the treaties under section 90 and 90A. These are the treaties which are entered by India with other countries. So any information like any tax credit or any other information can also be given in the new form 26 years. So these are the details which one needs to see that these will be available, and this as one can see, this totally expands the scope of form 26 AS, and it gives more and more details. It is no more a tax credit statement. It is really like a financial transaction passbook, wherein the scope has been widened considerably. So recently the government Shri Narendra Modi had proposed a scheme for honoring the honest taxpayers, wherein they have also made changes in the SFT transactions, thereby making a further proposal or making a further expansion in the details which will be portrayed in the form 26 ES. So as I have illustrated all what we had got from the official tweet of the Ministry of Finance, wherein certain illustrations which I'll just speak about is very small and minute things like health insurance premium paid above rupees 20,000, or any property municipal taxes paid about 20,000 will also reflect. If you are doing any business class travel, which if it is domestic, then it will come. Any foreign travel will also get reflected. Any payment to hotels about 20,000, purchase of jewelry, paintings, any artistic items, white goods above rupees 1 lakh. So these are, one can read what all things are included, but the essence of putting this was that they are increasing the scope of form 26 AS day by day, and hence it is very relevant to check form 26 AS before filing of income tax return. Because what happens is, many times there are transactions or there are disclosures which has to be made in the income tax return form, and that should match with the SFT transactions which will now be displayed in the form 26 AS. To an extent possible, obviously, but if there is a mismatch or if there is a variance, then the income tax department can very well start inquiring into the things, that why there is a difference between what is displayed in form 26s and what you have filed in the income tax returns. So now it makes very pertinent to check the forms to check the form 26 AS before you start filing your income tax returns. Like for a simple instance, before moving on, that as I mentioned, health insurance premium of about rupees 20,000, that is now to be reflected in our income tax return form under chapter 6A deductions. We claim exemption for any medical premium paid under section 80D. Now that allows you the premium which is paid for yourself, for your dependent family, for your minor kids, and your senior citizen parents. So if that details which is provided under the chapter 6A column, if that premium probably does not match with what is there in the form 26 AS, which is uploaded by the insurance authorities to the income tax department, then there may be an issue at a later stage. So this is just one instance. There can be many such instances, and that is the reason why form 26 AS is now becoming and gaining more and more importance. Now, coming to the amendments which were made because of COVID. So, the most important amendment which was made is the change due dates. I'm sure everyone would be aware of that. Every year we have date of 31st July for all non-tax audit cases. For tax audit, the date is 31st October, and for transfer pricing, the date is 30th November. So they have been amending the due dates or extending the due dates right from March, and there are multiple notifications and ordinances which have been promulgated. The last notification is dated 24th June, which is currently applicable, in which the extension of due date has been made to 30th November. So all the income tax returns, whether tax audit, non-tax audit, or transfer pricing cases, all the returns have to be filed before 30th November. So there is one single deadline for all the income tax returns only for this particular year. There is one thing which one needs to notice, that if the self-assessment tax liability, which is the net tax liability after you compute your income tax, you compute your incomes and your taxes, the net tax liability, if that is more than 1 lakh, then to avoid interest under section 234A, you will have to pay that before the original due date. So suppose if I am an individual, a non-tax audit individual, my deadline is 31st July. In that case, if my tax liability is more than 1 lakh, I will have to pay the SA tax before 31st July. If I don't pay before 31st July, interest under section 234A will be levied by the income tax department. So it will automatically compute in the return form from that particular date. So to avoid the interest under 234A, interest under section 234A is the interest which is charged or levied because of filing the return late beyond the due date. So this is that interest. So it, for these particular purposes, it will be considered and interest will be levied. There is no change in interest under section 234 and 234B and C in the said notification. So that will be continued to be levied. So one needs to be sure before filing returns of income that if you have a huge tax liability, a self-assessment tax liability, better be sure to pay those tax liabilities at an early date before 31st July, so as to get out of the rigors of interest under section 234A and as well as B and C, because that will also reduce to a certain extent. So that is one thing which one needs to take care of. This particular thing of paying the SA tax before the original due date does not apply to senior citizens. So that exemption is given to senior citizens. Senior citizens can pay before any date, before 30th November, that is before due date of return filing. There are various other extensions which were made. So the tax audit report date is also likewise extended till 31st October. So tax audit has to be furnished 1 month prior to the return filing date. So 31st October is the due date for all the tax audits. There are various sections under which tax audit report is filed, wherein section 10AA for charitable trust, or a MAT report under 115JB, or a 80JJ deduction report. So these any audit reports will have to be filed before 31st October. For charitable organizations or trust, there was a change which was made in the Finance Act 2020, wherein a charitable trust or an institution had to apply for a new approval for registration. That date also has been extended till 31st December. So the only catch here why I have mentioned here is that this date has been extended till 31st December. However, the return filing date is 30th November. So, and in the income tax return form, ITR 7, which is the return form for charitable trust and organizations, that ITR 7 requires to mention all the details of the new procedure for approval. So when the approval was asked for, when it was sought, when it was filed before, and if the approval has been granted, then what is the date or what are the documents submitted. So all those things are there is a specific schedule which they have made in the new return form, which we will cover later. But so one needs to be careful that in case that details are to be submitted, then to ask or seek for a new approval for such charitable trust or organizations before the due date filing date, so that we can provide those details. If it is not done, then the person will not be, an assessee will not be able to file those details in the income tax return form. We as of now don't know that without filing those details whether return shall get validated or not, because the utilities for ITR 7 has not come up. So that one has to wait and see that what is going to happen if the assessee does not give all those details in the return forms. So all the assessments, regular assessments for assessment year 18-19 and transfer pricing assessments, all these due dates are also extended because they were falling in this particular duration. So they have been extended to 31st March, and all time barring or reopening matters have also been extended. So another specific exemptions which have been made is the deductions which we claim. Deductions under section 54 to 54G are the deductions which are taken to claim a deduction against a capital gains income. So for that, an assessee is required to make investment as prescribed in that particular section. If the due date of that investment was falling under this COVID period, then that is extended till 30th September. So suppose if a person has to purchase a new property or construct a new property so as to avail a deduction under section 54 or 54F, then in that case that they can do so till 30th September, and that will be available and allowed in the return filing. So there is a specific fields which they have made wherein those details have to be reported. The dates for claiming deductions under chapter 6A. So all the deductions which we claim, like life insurance premium on loan repayment of a housing loan, or donations which have been made, medical premium, all these deductions which one claims, that due date was extended to 31st July. So any investments which were made till 31st July, that an assessee can choose to claim those deductions in assessment year 2021. Just one point I would like to highlight here is that if an assessee has made an investment, for example, on 1st of April 2020, in that case the assessee has an option to whether take the deduction for assessment year 2021 or for the next assessment year, which is 21-22, because that will equally apply. So obviously the deduction can be claimed only once, but the assessee has an option to choose under which assessment year the assessee wants to claim that deduction. Also there was a requirement for linking of PAN and Aadhaar card. This has been going since long. However, this also has been extended till 31st March. So that relief has been provided. Any furnishing of specified financial transactions about which we spoke in length earlier, for financial year 1920, so this is the assessment year 2021 for which this is there. This is also extended till 31st March 21. So it may happen that there is a transaction of financial year 1920 which you have entered. However, since the due date for filing this specified financial transactions has been extended, the authority or the entity who is supposed to file has not filed the statement, and because of that it is not reflecting into your form 26A. So do not worry, because this deadline has exceeded. So many transactions may appear at a later date. It will appear even after you file the return of income. So if there is a mismatch, then you may consider that those transactions have been not reported by those entities. Due date for furnishing TDS returns for the quarter end 31st March 20, which is the last quarter of financial year 1920. This was also extended till 15 July for government deductors, 31st July for non-government deductors, and consequent furnishing of form 16, which is 16 or 16A, which is the TDS certificate for salary or any other payments, was extended till 15th August 2020. So by now, all the assessees or deductors who have filed the return on time would be able to give the TDS certificates to the assessees. So if you have not received your TDS certificate on salary or any other payments, or it is not reflecting in form 26A, one may start verifying from the deductor so that those details will start reflecting. So now this was regarding pertaining to this particular assessment year, the due dates, etc. Now we will move on to the changes which have been made and the subsequent changes which were made in the income tax return forms because of these amendments. So I have covered majorly all those amendments which are relating to income tax return filing. Coming to the basics, the slab rates or the tax rates which are there, there has been no change in assessment year 2021 in the slab rates of individuals, whether senior citizens or super senior citizens. So there is no change. One can just read it through. This is just for information. There is also there is no change in the health and education cess, that continues to remain at 4%. There was a rebate which is available under section 87A. This rebate was earlier available only up to 2,500 from the tax liability. Now that has been extended from 2,500 to 12,500, and also the total income, if the total income of the assessee does not exceed 5 lakhs, then the rebate can be claimed. So this has also been exceeded. Earlier it was 3 lakh 50,000. Now it has been exceeded or extended to 5 lakhs. So if you are an assessee who has an income which is less than 5 lakhs, then the rebate up to rupees 12,500 can be claimed by the assessee. The tax rates for domestic companies was or is 25%. However, this 25% concessional tax rate was applicable only if the turnover of that company was 250 crores or less. Now that turnover limit they have increased to 400 crores. So that is an advantage or a benefit which has been given. So if the assessee is a domestic company having a turnover of 400 crores or less for financial year 17-18, then the tax rate will be 25%. The MAT rate also has been reduced from 18.5% to 15%, and for other domestic companies, the rate shall continue to be 30%. Now coming to the new tax regime, I think we all are aware on this new tax regime or the concession which was provided by the government to the new to the companies. So there were few sections which were introduced, wherein section 115BA is a section which specifies that if a company is a manufacturing company or is into production of any article or things, and it is incorporated on or after 1st March 2016, then the reduced rate was 25%. If this kind of company is incorporated on or after 1st October 2019, since the notification came at that time, so just recently in the last year after October 2019, if such company has been incorporated and is into manufacturing, there is a reduced rate of 15%. And for all other non-manufacturing companies, the reduced rate is 22%. Now, what is the catch here is that the reduced rates shall apply only if those companies are foregoing the deductions and exemptions which are specified under those sections and under the Act. So there is a restriction on claiming the exemption and deduction. So if a company is willing to forego those, so there is a huge list. I will not name into what all pertains in that, but for example, additional depreciation or any site restoration fund deduction. So any deductions which are mentioned in the specified section, if those are not claimed, then the company will be able to avail the reduced tax rate. For reduced tax rate, the surcharge will be standard at the rate of 10% and will follow by education cess. So this is as regards to the new tax regime. If the company wants to avail all the deductions and does not want to form part of these, then the limit of 400 crores which I specified earlier will apply. So if the turnover is less than 400 crores, then a reduced rate of 25% will apply, and if not, then a rate of 30%. This new tax regime is applicable for domestic companies only. Also, if a company chooses to be under the new tax regime, the MAT is not applicable. So there is no applicability of MAT under section 115 JB. So this is relevant for the reason that one has to choose under which scheme they want to, if they want to apply for a new tax regime, the company will have to make a choice before the return filing, and this is the first year to make such choice. So a company or the assessee has to do a benefit analysis or a cost benefit analysis, that where which option is better for that particular company, and avail the option accordingly. Now coming to surcharge, as I mentioned, there was no change in the slab rates, the basic slab rates. However, the Finance Act 2019 made a significant change in surcharge for individuals and HUFs, etc. So they have made it progressively taxed. So the richer is taxed more. So if the income exceeds 1 crore and it is between 1 to 2 crores, then the rate of surcharge is 15%. If it is between 2 to 5 crores, 25%, and if the income crosses 5 crore, then a highest surcharge rate of 37%. So this is the new change in the surcharge. Up till now there was only a rate of 15%. Now they have increased to 25 and 37. However, there was a lot of appeal which was made after these amendments that these rates should not apply to capital gains. So they have given that benefit that if there is a short-term capital gains or long-term capital gains to resident or non-residents, then this enhanced rates of 25 and 37% will not apply. It will continue to be taxed at a surcharge rate of 10 or 15% based on the income. So on capital gains transaction, there is a benefit to that extent that the higher surcharge rate will not apply. For other assessees, for firms, cooperative societies, etc., there is no change in the surcharge rate. However, for domestic companies, the surcharge rate has been increased if the income crosses 10 crores. So it is from 7 to 12%, as well as for foreign companies. So for them also, the surcharge rate has been enhanced from 2 to 5% if the income crosses 10 crores. All these changes, again for the sake of repetition, applies for this assessment year. Now coming to the non-tax rates changes which have been made. So starting from salary, we know that there is a standard deduction which is available from salary income. Up till now it was available up to 40,000. Now it is up to 50,000. This will have been taken care of by the employer itself. So that would have been forming part of your Form 16. As regards to income from house property, up till now, any one self-occupied property, self-occupied residential property, the assessee was considering the same as exempt, or the value of that property was considered as nil. The net asset value was considered as nil of that property. There was no notional value. Now they have extended the benefit to two self-occupied properties. So if I am, for example, I am an assessee having two residential self-occupied properties. For both the properties, I will consider the notional rental value as zero, and I will claim any deduction under 24B or any interest which is there. For the third property, there will be a notional rental value. There is a change which has been made under deduction under section 24B also. This is a deduction which is claimed because of interest on housing loan. So on the borrowed capital, this will continue to remain at 2 lakhs. So this there is no change in the deduction amount. That is, the cap is 2 lakhs for both the properties. So even if I have, suppose, an interest on two self-occupied properties of 6 lakhs, I will have to cap it to 2 lakhs. It is not per property, it is in aggregate. Moving on to income from other sources. Section 56(2)(10) basically taxes any income, movable property, or any sum of property which has been received by any assessee from any assessee beyond the fair market value. That is taxed as income from other sources. Up till now, it did not make any reference to non-resident, because of the reason that section 9 is a section which deems which is a deeming fiction or a deeming provision for accruing or deemed accrual of any income to a non-resident. So that section did not have such provisions. So now they have made changes across in section 2(9) and 56(2)(10). The result of the amendments is that now if any sum of property is any sum of money which is given by a resident to a non-resident will be taxable to non-resident under section 56(2)(10). So provided it is beyond 50,000 rupees as mentioned in the section. and the exemptions, other exemptions will continue to apply. So it should not be a relative or something like or all other exemptions which are provided. So apart from that, if any sum of money is given, then it will be charged to tax, and the non-resident has to file the return of income and consider this as income from other sources. So one needs to take care if such receipts have been have been received by the non-resident assessees. 5627B is one such section which makes an addition to any share premium which is received by a company over and above the fair market value of the price of the shares. So in this section there were certain categories which were exempted. Category 1 AIF, alternate investment fund, was excluded. Now they have extended that to category 2 as well. Also startups are excluded from this. So any investment which is made in startups will not form part of this section, and it will not be taxed, and hence it's called as angel tax provisions. However, it has made an amendment that there are conditions which are specified. If any of the conditions are not complied with, the excess will be taxed in the year of failure or non-compliance. So so one has to adhere to those conditions to avail this exemption, this exception. Now coming to other heads of income, which is business and professional and capital gains income. So section 43B is a section which allows various payments specified in the section based on payment basis. So once the payment is made, the deduction of that section is allowed. So any interest which is paid on any loan or borrowing was allowed under section 43B on payment basis. Now that has been extended to NBFCs, deposit taking and non-deposit takings. So if I have borrowed any loan from NBFCs and paid interest, that will be allowed to me as deduction. However, they have clarified that any conversion of interest into loan, so if I convert my existing interest into a loan, that is not considered as payment. So that will not be allowed as deduction under 43B. There is a significant amendment or a benefit which has been given under section 54. Section 54 was giving a deduction if an assessee purchases one residential property from the capital gains receipts of another residential property. So that was allowed. However, this was allowed only for purchase of one property. Now the assessee, even if purchases two residential properties, then up to rupees 2 crores the deduction can be claimed. So that if there are two properties, then accordingly that two properties will have to be furnished in the income tax return forms so as to claim the deduction. Short-term capital gains has two different rates: 15% for all STT paid transactions under section 111A, and maximum slab rate for all other transactions. So now they have included even funds of funds under section 111A. So if you have invested into units of funds, then also concessional rate will apply. So if you are an assessee who have made such investments and made such transfers during the year, then please avail the concessional rate. Now coming to pass-through entities, so there was a change and amendment which was made in pass-through entities, and as a effect of that, there are several schedules under the income tax forms wherein changes have been made. So all those pass-through entities, all the AIFs, alternate investment funds or venture capital funds, the model of taxation for those VCFs or AIFs was that except for business income, all other income was taxed at the unit holder level. So business income was taxed at the AIF level and non-business income was taxed at the unit holder level. However, there was nothing in the law which was there for losses. So they have made that change that now all the business losses will be allowed to be set off and carried forward at the fund level, and all the non-business losses will be allowed to the unit holders. However, this advantage of taking the losses or setting it off will be available to only those unit holders which have held the units for 12 months or more. So a long-term unit holder. also all accumulated losses, non-business losses up till 31st March will also be allowed to the unit holder. So that if the assessee is a unit holder of such kind of funds, then one needs to see that such losses are now claimed in the return of income and the advantage is taken. So we will see what are the changes in the forms at a later stage. Coming to certain changes which are made in the basic return filing provisions itself. So, section 140A is a section which calculates or computes the self-assessment tax liability. Before calculation of self-assessment tax liability, we generally reduce all the prepaid taxes like TDS, advance tax, etc. However, relief under section 89 was not reduced. So now they have made that amendment that if you are claiming any tax relief under section 89, that also has to be reduced from 140A, and then the self-assessment tax will have to be paid. The impact of this is that even for calculation of interest under section 234B and C, these interests are calculated on the self-assessment tax liability. So for that also the tax relief will have to be reduced, and only on the balance portion the interest will have to be calculated. So the Finance Act also made some significant changes or additions in section 139(1), which is a section which mentions the situations for which there is a mandatory return filing. So there are situations which are given, and if an assessee falls in those conditions, then the return has to be mandatorily filed, irrespective of the tax to be paid or the income which the assessee has. So the seventh proviso mentions those. There are quite a few changes which have been made in that particular provision, and one has to choose. There is a new schedule which have been introduced, and one has to choose under which proviso the assessee is filing the return. So what are those mandatory things? We will get into detailed at a later stage. The interchangeability of PAN and Aadhaar card was prescribed under 139A. So wherever the Aadhaar card is not there, the assessee can provide the PAN number and vice versa. This interchangeability is facilitated in the forms at various places, and hence one needs to take care if Aadhaar is not there to mention the PAN number in the forms wherever required. Non-quoting has some penal consequences. So this application is from this assessment year. Up till now, prosecution could happen for non-filing of return only if the returned income was more than 3,000. Now they have given a little benefit wherein they have increased that to 10,000. So if my tax liability or the tax payment is less than 10,000 and I have not filed the return of income, at least prosecution won't happen. The penal consequences may be there, but prosecution won't happen. Coming to deductions, these are the specific deductions and the first year to claim those deductions, and hence it is worthy to be discussed. Section 80EE, this is the interest on loan taken for residential properties. So up to 1,50,000, that interest on loan will be allowed under section 80EEA. Obviously, there are a lot of conditions which they have specified. So there is a condition for sanction date, and also condition for the stamp duty value of the property that should not exceed 45 lakhs. So if you fit into those conditions of the section, then a new deduction schedule has been provided, and one has to claim the deduction by providing the details in this schedule. Another section which was introduced for promoting the environment was for electrical vehicles. So any interest which accrues to me or which is paid on loan taken for purchase of electrical vehicles, up to rupees 1,50,000 of interest will now be allowed. So again, there are conditions on the sanctioning of loan and the applicability of the deduction. So one has to see whether those conditions are met with. If those are met, then a deduction can be taken under this section. Once a deduction is taken under this section, that interest cannot be claimed under any other section. Just one point which I missed for the housing loan interest is that 1,50,000 interest is available and one can claim under section 80 EEA. Suppose if an assessee has a more interest, like if I have an interest of suppose 3 lakhs, then 1,50,000 I can claim under 80 EEA, and another 1,50,000 I can continue to claim under section 24B under income from house property. So that one needs to take care. If the interest is more than 1,50,000, there will be very rare cases where it will be more than 1,50,000 because the property value itself is less. But if it is a case, then the additional interest can be continued to be claimed under section 24B. Now, all the units which are located in IFSC, which is International Financial Service Centers, there was a tax holiday which was provided for them under Section 80 LA, wherein a deduction of 100% was given for first 5 years of profits and 50% for another 5 years. Now they have extended the benefit to 100% for 10 consecutive years, and the assessee is at a liberty to choose from which year the assessee will start claiming that deduction out of the first 15 years. So this claim has to be made from, and the first year has to be chosen, and the deduction has to be claimed under this particular section. Now, coming to a few miscellaneous amendments which impacts the return forms. We have secondary adjustments under transfer pricing. So secondary adjustments are something which follows the primary adjustment, and to that extent, the secondary adjustments have to be reported in the income tax return form. So there have been certain changes which have been made in the income tax return forms for reporting of such secondary adjustment. Also, if the amount due because of this secondary adjustment is not repatriated to India, that excess amount has to be repatriated to India. If it is not given within the prescribed time limit, then there will be an interest which will be levied at the rate of 18%, and that amount will be considered as a loan or an advance from the associated enterprise. So there is a provision which has been made in the return form for also calculation of that interest and the amounts to be mentioned in the return forms. So this is strictly relating to the transfer pricing cases. Coming to the carry forward losses section 79. So section 79 says that no losses can be carried forward if there is a change in the shareholding of the company. So however, they have provided an exemption or made a specific case for all the startups which are eligible under section 80 IAC. So this is a welcome move for startups, since startups have a lot of private equity investments and a lot of another third party investments which are brought into the company, and the shareholding keeps changing. So for that reason, they have provided that this section will not apply to so these conditions will not apply to startup companies, and even if there is a change in their shareholding, they can continue to carry forward their losses. So this is a startup specific amendment. As I mentioned earlier, specific financial transactions. So there was a limit wherein the CBDT can prescribe different values for prescribing under specified financial transactions. There was a limit earlier of 50,000. So any transaction less than 50,000 CBDT could not prescribe. Now that limit has been removed, and the CBDT can continue to expand the scope or set the different values for specified financial transactions. Now, coming to specific amendments of Finance Act 2020. So I had mentioned there are few amendments of 2020 which are applicable for assessment of 2021. So coming to that, regarding charitable trust, so all the charitable trust organizations, NGOs, or scientific research institution, educational institutions which come under or claim exemption under section 11 or 1023 C and so on and so forth, these charitable trust and organizations are now required under the new section 12 AB to make a fresh registration to claim exemptions, being a charitable trust. So irrespective of an old organization or new, everyone now has to make a new registration application to the PCIT. I had mentioned that the time limits for the same have been extended. So earlier it was 1st of June. Now that has been extended to October. So within 3 months of 1st October, the application has to be submitted, or the intimation has to be made to the Principal Commissioner of Income Tax. That means up to 31st December. So any trust or organization can now make an application up to 31st December. The PCIT can call for documents to satisfy itself about the genuineness of the trust activities, and accordingly will give the registration only for 5 years. So this applies to all. As I've mentioned, there is a kind of an anomaly that these information has to be provided in the income tax return forms, and hence one needs to plan in advance to make such applications so that we can comply with the information in the return form. One doesn't know, or one has not tested that what will happen if these details are not given in the income tax return forms due to clash of deadlines. So that, I think, we'll come to know as time grows. And there was a significant change and a very welcome move made for the tax audit limit. So tax audit limit under section 44AB was 1 crore. Now that limit has been enhanced to 5 crores, provided two conditions are specified, that the cash receipts during the previous year does not exceed 5% of the aggregate receipts, and cash payments during the previous year does not exceed 5% of the aggregate payments. So if these two conditions are specified, so they are giving a cap to the cash receipts and promoting digital transactions. So digital and banking transactions. So if this is the case, if your business has less than 5% of cash receipts and cash payments, then you can avail the enhanced limit of 5 crores, and up to 5 crores there will be no tax audit required under section 44AB. Now, what is aggregate receipt and what is an aggregate payment, one needs to compute, because this is the entire basis of claiming relief from tax audit. So this is something which one has to do. The irony here is that even though the assessee is not required to furnish the tax audit report, the assessee is very well required to compute its aggregate receipts and payments, because then only the assessee will be able to establish that it does not exceed 5%. The cash receipts or payment does not exceed. So what is an aggregate receipt or payment? One needs to be very careful in computing that before filing the return, rather much before filing the return, because if tax audit is applicable, the date is 1 month prior to the return filing, which is 31st October. So before 31st October, much before that, the assessee needs to look into all those cases which falls within the 1 crore to 5 crore bracket of turnover, and look. Also I would like to clarify here that this is aggregate of receipts and not turnover. So all the receipts may be much beyond 5 crores. So one has to compute all the receipts. There is one logic here, that all the receipts and payments obviously pertaining to business will be there. So if there is any personal receipt, like a gift which has been received, that will not form part of here, because it is not so a gift which is received by an individual, that is a personal income, that is not a business income, and that is why that is not forming part of an aggregate receipt. Likewise, if I am paying some other payments, suppose like tuition fees of my kids, these should not form part of here, because this is only business payments. So that is one logic which should apply more or less. Apart from that, one has to see that receivables and payables, the outstanding balances are not reflecting in receipts and payments. It is strictly receipts and payments. So any opening balances and closing balances ideally should not form part of this aggregate receipts and payments. There will be multiple instances and several scenarios of confusions of what could be the receipt or a payment. So hence I'm telling, one needs to be well planned and in advance to compute that, because this will determine whether you are applicable to tax audit or not. So there will be many such scenarios. If there are different scenarios which I have, I just take 2 minutes for that. That what are the different kind of scenarios because of this change limits. One scenario is that your turnover is less than 1 crore. In that case, tax audit does not apply at all. If your turnover is more than 1 crore, however your cash receipts or payments exceeds 5%, in that case you cannot claim benefit of section 44ab. However, if your turnover is between 1 crore to 2 crores, so suppose take an example that my turnover is 1.5 crores, however my cash receipts and payments are 15%, so I abridge the condition under 44ab. However, 44AD, which is a presumptive section, mentions a turnover limit of 2 crores, and that does not have any limit of cash receipts or payments. It just indicates a different tax rate. So if 44AD says that your cash transactions will be 8% profit, non-cash transactions will be 6% profits. So that doesn't mention anything else. So if you are having a turnover between 1 crore to 5 crore, and you are exceeding the cash limit of 5%, you can still fall under presumptive taxation, and audit is not required but under section 44AD. So these are the few small intricacies. Also, one another example which I'll bring about is that suppose if my turnover is say 3 crores, and I my cash receipts etc are less than 5%, in that case tax audit is not required under section 44ab. And if I have a reduced rate, suppose I'm showing a profit of 2%, and I'm paying taxes accordingly, that is allowed. However, if my turnover is less than 2 crores, if that is the scenario, then if a lesser rate is shown, lesser rate than 6% or 8%, in that case there is mandatory tax audit under section 44AD. So these are a few of the instances one needs to be very careful before deciding whether tax audit is applicable or not. So pay extra attention to this section before your tax audit season. So I think that's all for the amendments which one needs to keep in the head before filing. Now we will move on, and Vishesh will speak on the income tax return forms and their applicability. Thanks. Over to you, Vishesh.
Thank you, Kinjal.
Yes.
Just a moment, I'll share my screen.
Yes, perfect.
Yes, great. Good evening to everyone. Today it's 31st August 2020, and I'm sure we all are in the midst of hectic tax filing season for assessment year 2021. Up to 31st July 2020, as per the statistics which are available on the income tax portal, around 50 lakh returns have been filed for assessment year 2021. If this figure is compared to last year, obviously we are lacking behind. Obviously, because the entire country is facing the the pandemic crisis, and hopefully all the ITR forms are filed much prior to the due dates. Before we file the ITR forms, it's very important to understand what are the intricacies and what are the amendments which are made in these ITR forms, and hence I would like to highlight what are the the changes which are being brought about in the ITR forms. Firstly, who is required to file an income tax return? The statutory condition to file an income tax return is provided in section 139(1) of the Income Tax Act. Clause A of section 139(1) states that any company or a firm, irrespective of their income or their loss, are mandatorily required to file an income tax return. Clause B states that any person other than a firm or a company whose total income exceeds the basic exemption limit, that person is mandatorily required to file the ITR form. These are the two basic conditions in this section. Then there's an interesting fourth proviso to section 139(1), which states that if a resident taxpayer, even though if the total income of that person does not exceed the exemption limit, but if that person holds any foreign asset outside India or is a beneficiary of any asset outside India, then that person is required to file the ITR form. Let's understand this with the help of an example. Suppose a student, after completing his graduation in India, intends to go to Canada to pursue an MBA course. He goes to Canada in November 2019. So practically for financial year 1920, he was in India for 182 days. And hence he is classified as a resident and ordinary resident. When he was in India, he had earned nearly an interest income of 1 lakh rupees and there is no other income. When he goes to Canada, he opens a foreign bank account, he opens a bank account over there. And hence if you see for financial year 1920, he fulfills two conditions. Firstly, his income is below the exemption limit, but he holds an account outside India and hence he is mandatorily required to file the ITR form. Moving on to the next proviso, sixth proviso to section 139(1)(b. There is a small amendment which is effective from the current assessment year, which is assessment year 2021. Let's understand this with the help of an illustration. Suppose Mr. A sells his house property and earns a long-term capital gain of rupees 10 lakhs on the transfer of this flat. The capital gain is reinvested in another flat and hence he intends to claim the deduction under section 54. Apart from this transaction, he has an interest income of rupees 1 lakh and there is no other income. So this amendment states that if the total income of a person before giving effect to the deduction under section 54 to 54 GB, if the total income exceeds the basic exemption limit, then that person is required to file the income tax return form. So in this example, before giving effect to deduction under section 54, the income exceeded the exemption limit and hence that person is required to file the ITR form. Moving on to the next amended provision, seventh proviso. This proviso is effective for the first time for the current assessment year, which is assessment year 2021. Now, before this seventh proviso was inserted in the Income Tax Act, the government realized that one of the possible ways by which a large number of people can be brought under the tax net is to identify taxpayers through economic indicators. And hence, with this intention, this proviso has been inserted. Similar provisions were there in the Income Tax Act up to assessment year 2006-2007. Later on, they were omitted and some of the provisions have been reintroduced here. This proviso states that if a person other than a company or a firm, if the total income of that person does not exceed the basic exemption limit, but if that person fulfills any of the following conditions, then he is required to file the ITR form. The first condition states that a person, if that person has deposited an amount or an aggregate of amount exceeding 1 crore in one or more current account. Very important condition to be kept in mind is the proviso talks about deposited an amount. It does not merely talk about cash deposits. Deposit in your bank account as well as cash deposits. If that exceeds 1 crore, this condition is fulfilled. Practically what a person needs to do is, aggregate all the transactions which are reflecting on the credit side of the bank statement. If the total of that figure exceeds 1 crore, this condition is fulfilled. There could be scenarios where a person would have received a loan, or probably they would have received a gift, or maybe a person would have just transferred some amount from one bank account to another bank account of his. And if the summation of all the credit entries exceeds 1 crore, this condition is getting fulfilled. Second condition under 7th proviso states that if a person has incurred an amount or aggregate of amount exceeding 2 lakh rupees, either for himself or for any other person for travel to a foreign country. So this condition talks about foreign travel expenditure. Here, of course, the expenditure could have either been incurred through forex cards or maybe debit card, credit card, cash. Even purchase of air tickets would have to be factored in. If all the expenditures incurred exceeds 2 lakhs and if the person's income does not exceed the basic exemption limit, still he is required to file the ITR form. And lastly, the third condition states that if the person has incurred expenditure of an amount or aggregate of an amount exceeding 1 lakh towards consumption of electricity. Now here electricity could have been incurred, maybe for residential purpose or maybe for business purpose. This condition is inserted with a view to track those persons who are probably carrying on some sort of business activity or economic activity, either from their houses or maybe small places. And majority of the transactions are not through banking transactions. So if a person is incurring an expenditure of more than 1 lakh towards electricity, it definitely shows that there is some sort of business activities which is being carried out, and hence to track all such persons, this condition has been inserted in 7th proviso. To incorporate these amendments made in 7th proviso, certain amendments are made in the ITR forms 1, 2, 3 and 4, wherein specific columns have been inserted in the schedule general information. Firstly, the taxpayer is required to tick the checkbox and select yes or no whether the tax return is being filed because one of the conditions under 7th proviso is being fulfilled. If yes, then that taxpayer is required to denote which of these specific conditions is getting triggered. For example, if condition number 1, which talks about deposit, is getting triggered, then the taxpayer is required to denote the exact amount of deposit in the current account. Similarly, for condition number 2 and condition 3, the taxpayer is required to denote the exact amount of foreign travel expenditure incurred either for himself or for any other person. And third condition is he has to denote the exact amount of electricity charges which have been incurred during the year. So an important amendment as far as 7th proviso is concerned, and these amendments are made in ITR forms 1, 2, 3 and 4. Moving on to the next slide. Prime Minister Modi ji addressed the nation on 13th of August on the theme Transparent Taxation and Honoring the Honest. Soon after Prime Minister's address, an announcement was made by the Ministry of Finance on its Twitter handle. And I've just copy pasted that announcement which was released on the Twitter. The first part talks about the SFT filing, the expansion of SFT filing, and the second part, which I've highlighted in red, pertains to tax return filing. Just keep in mind these are mere announcements; they are not effective as on today's date, but sooner or later they would be introduced in the Income Tax Act. The first announcement made pertains to deduction or collection of tax at higher rates for non-filers of return. So they propose to increase the TDS or TCS rates in case the payee is not filing the tax return. The second announcement pertains to compulsory filing of ITR forms by 3 categories of people. Firstly, if the person has banking transactions exceeding rupees 30 lakhs. Secondly, all professionals and businesses having turnover more than 50 lakhs. And thirdly, payment of rent above 40,000. These are the proposed announcements, and one needs to keep these transactions in mind for future transactions. Moving on to the next slide, notification of the ITR forms for assessment year 2021. This year, on 3rd January 2020 itself, in a very surprising move, CBDT had notified 2 ITR forms, which were ITR 1 Surge and ITR 4 Sugam. It was considered to be a very welcome move because they had notified 2 forms much prior to their filing season. Generally, these forms are notified either in the late days of March or in the early days of April when the tax filing season starts. All the tax professionals hope that even the other ITR forms would be notified pretty soon, and which would give the ample time to prepare for the compliances. Unfortunately, the country was facing the pandemic crisis, which eventually also led to the delay in issuance of the ITR forms. Finally, all the ITR forms were notified by way of a notification dated 29th May 2020. This notification superseded the earlier one, and all the ITR forms were re-notified. As far as the ITR online utilities are concerned, ITR online utilities for ITR 1, 2, 3, 4 and 5 are available on the income tax portal. For utilities for 6 and 7 are yet not being released on the tax portal. In fact, the utility for ITR 5 was also released just 5 days before, that was on 25th of August. Moving on to the applicability criteria for ITR forms, more or less there is no major amendment as far as applicability is concerned as compared to the previous assessment year. ITR 1 is applicable for resident individuals having income up to 50 lakhs and for individuals who hold only one house property and the agricultural income does not exceed rupees 5,000. ITR 2 form is applicable for individuals and HUFs not having any income from business or profession. ITR 3 is applicable for all individuals and HUFs having income from business or profession. ITR 4 is applicable for presumptive taxpayers. An important thing to be kept in mind here is ITR 1 and ITR 4, which are Surge and Sugam. They are not applicable to individuals who are either directors in a company or they hold any unlisted equity shares of a company. Moving on to ITR 5. This form would be applicable to partnership firms, LLPs, unregistered trust. ITR 6 would be applicable for companies other than companies claiming exemption under Section 11. And ITR 7 would be applicable for all registered charitable trust, electoral trust, and political parties. Moving on to the important changes in the ITR forms for assessment year 2021. What I've done is I've tried to create separate buckets as far as the changes are concerned. The first bucket pertains to the changes in the ITR forms, primarily due to the COVID-19 pandemic. Now, as we remember, on 31st March 2020, an ordinance was promulgated, and because of this ordinance, the time limit to claim deduction for financial year 1920, deductions under Chapter 6A, deduction under Section 10AA, Sections 54 to 54 GB. To claim all these deductions for financial year 1920, the time limit was extended to 30th of June. Further, this date of 30th June was further extended to 31st July for few sections and 30th September for other sections. To incorporate all these amendments, a specific schedule DI has been inserted in ITR forms 1, 2, 3, 4, 5, 6, wherein now this schedule DI consists of 3 columns. The first column pertains to all the available deductions under different sections. The second column, in the second column, the taxpayer is required to intimate the eligible amount of deduction for financial year 1920. And third column states that if any amount has been invested or paid during the period of 1st of April 2020 to 31st July, then the amount has to be reported in column number 3. So for example, under Section 80C, the taxpayer is eligible to claim an amount of rupees 1,25,000. The amount of 1,25,000 is to be reported in column number 2. And out of this 1,25,000, if any amount is paid from 1st of April to 31st July, so in this case, the taxpayer has paid 25,000 after 31st March, then that amount is to be reported in column number 3. An important point to be kept in mind here is that it is not mandatory, but an option given to the taxpayer that if any amount is paid from 1st of April 2020 to 31st July 2020, the taxpayer has an option to claim that amount either for financial year 1920 or for financial year 2021. It is not a mandatory requirement that it has to be claimed for financial year 1920 itself. Similarly, for ITR forms 3, 5, and 6, certain additional columns are there in Schedule DI, wherein if any conditions to claim the deduction under Section 10AA are fulfilled during the extended period of 1st of April to 30th September, those details are to be reported in these columns. Similarly, if a person is claiming deductions under Section 54 to 54 GB, and if any amount has been paid or invested in another flat or maybe bonds during the extended period, those amounts are to be reported in column number 3. This column has been inserted just to keep a track that the taxpayer is not claiming double deductions in the form for financial year 1920 as well as for financial year 2021, and just to avoid those kind of scenarios, this column has been inserted. Moving on to the next set of amendments, the general amendments in the ITR forms. The first amendment pertains to the document identification number, which is DIN. Now, as we know that CBDT has made it mandatory for all the income tax authorities to quote a unique document identification number on each and every document or correspondence which is released or issued by them to the taxpayer. This mechanism was primarily, put in place just to keep a proper audit trail of all the correspondences between the tax department and the taxpayer. So now, if any taxpayer is filing an income tax return in response to these notices under section 139 or maybe 142(1), etc., the taxpayer is compulsorily required to intimate the document identification number specified in the notice. Moving on to the next amendment pertaining to directorship details and as well as the unlisted shares. Now, if a taxpayer is a director in a company or if he holds unlisted equity shares, then certain disclosures of that company are required in the ITR forms. Now, an additional column has been inserted for ITRs 2, 3, and 7 for this year. And now the taxpayer is required to intimate the type of the company. There would be two options on the type of the company. Firstly, whether the company is a domestic company or a foreign company. If it's a domestic company, the PAN of the company is mandatorily required to be reported. And if it's a foreign company, PAN is not mandatory. Similar disclosures for unlisted equity shares as well. Moving on to the next amendment pertaining to audit information in ITRs 3, 5, and 6. Now, as Kinjal explained that up to assessment year 1920, if a person is carrying on business, then he is required to get his books of accounts audited under section 44AB if the turnover exceeded 1 crore. Now, for assessment year 2021, this threshold limit of 1 crore has been extended to 5 crores, provided two conditions are fulfilled. Condition number 1 is the cash receipt does not exceed 5% of the total receipts. And second condition is cash payments do not exceed 5% of the total payments. These are the two conditions, new conditions for the extended threshold limit of 5 crores. To incorporate these amendments, certain columns have been added in audit information in ITR forms 3, 5, and 6. And now the taxpayer is required to intimate whether the cash receipts exceed the 5% limit or the cash payment exceeds the 5% total payments. If the taxpayer ticks the option of yes, then tax audit would be mandatory. Moving on to the next slide, option to quote PAN or Aadhaar in various schedules. Now, if you remember, the Finance Minister Nirmala Sitharaman, during her budget speech of Finance Bill 2019, mentioned that as on that date, 120 crore Indians hold an Aadhaar card. And just for the purpose of ease and convenience, they would like to make PAN and Aadhaar interchangeable. Subsequently, an amendment was made in section 139A to enable this announcement. To incorporate all these amendments, the various schedules in ITR forms 1, 2, 3, 4, 5, 6, and 7, where the taxpayer is required to quote the PAN of the opposite party or of maybe the buyer or the tenant or the auditor details. Now the option has been given to the taxpayer to quote either the PAN of that person or the Aadhaar of that person, depending upon the availability. So I've just enlisted the various columns where PAN is required to be reported. Now even the Aadhaar of that person can be reported. Moving on to the next set of amendment pertaining to bank account for refund, a very welcome amendment in the ITR forms. Up to assessment year 1920, all the taxpayers who are filing the ITR forms were required to list down all the bank accounts held during the year. And out of all the listed bank accounts, the taxpayer was required to denote one bank account in which he would like to get the bank refund or the income tax refund. From this year, the taxpayer has been given an option to indicate multiple bank accounts for the purpose of receiving the tax refunds. Hopefully, this solves the various problems which are probably faced during the processing of income tax refunds on account of mismatch or revalidation of the IFSC code. Second amendment relates to non-residents. Again, a very welcome move. If at all a non-resident is filing an income tax return and he wishes to claim an income tax refund, but that person does not hold a bank account in India, a lot of problems were caused to receive that tax refund. Now an option has been given to non-residents as well to intimate a foreign bank account in order to receive the income tax refund. Moving on to the next set of amendments, changes in the ITR forms headwise. Firstly, income from salary. For assessment in 2021, a small amendment in scheduled salary is made, wherein the government employees have now been bifurcated into central government employees and state government employees. And another option of not applicable is also available under the head nature of employment. Probably if a taxpayer is receiving some sort of family pension, then this option of not applicable can be selected. This amendment is made in ITR forms 1, 2, and 3. Moving on to the next head of income, income from house property. Up to assessment in 1920, under the schedule HP, there were only 2 options available, which were let out and deemed to let out. Now, Income Tax Department has realized that Section 23, subsection 5 of the Income Tax Act states that if a person holds any property as stock in trade, and if that property is not let out during the year, then the annual lettable value of that property is nil for 2 years, 2 years from the year in which the occupation certificate was received. So considering these amendments in section 23 subsection 5, now another option of self-occupied is also inserted under the head nature of house property. And now the taxpayer can also denote whether the house property is self-occupied or let out or deemed to let out. This specific amendment is made in ITR forms 5 and 6. Moving on to the next head of income, profits and gains from business or profession. Now, up to assessment in 1920, only 3 blocks were available to calculate depreciation on plant and machinery, which were 15%, 30%, and 40%. On 23rd August 2019, the finance minister announced as a part of the stimulus package and as a part or as an incentive to give boost to the automobile sector, made 2 announcements. Firstly, she announced an additional depreciation of 15% on motor vehicles which were purchased from 23rd August 2019 to 31st March 2020. And secondly, an additional block of 45% was inserted for specific motor buses, lorries, or taxis which were purchased from 23rd August 2019 to 31st March 2020. These were the announcements made, and later on there was a notification released on 20th September giving a retrospective effect from 23rd August. To incorporate all these amendments, certain changes are made in ITR forms 3, 5, and 6 in schedule DPM, wherein an additional block of 45% is now introduced to enable the taxpayer to claim the depreciation at the rate of 45%. Consequential amendments are also made in Schedule DEP and Schedule DCG to claim the additional depreciation of 15% as well as the enhanced depreciation rate of 45%. Moving on to the next set of amendments in Part A, which talks about the other information. Specific columns have been added in this specific schedule. Firstly, at point 8H, reporting of disallowance under section 40 clause BA has been inserted. Now this section 40 clause BA talks about disallowance of any amount which is paid by an AOP or a BOI to its own members. Or probably if any payment is made on account of interest or salary to its own member, that amount is to be disallowed. In order to enable such kind of reporting, this column has been added at point number 8H. Secondly, at point 11DA, another column has been inserted. As Kinjal highlighted, that section 43B has been amended to provide that if any interest is paid on a loan taken from a deposit-taking NBFC or a systematically important NBFC, in those cases, interest would be allowed only on payment basis and not on accrual basis. To enable such kind of reporting under section 43B, an additional column has been inserted. And lastly, at point 17, the taxpayer is required to denote whether any secondary adjustment under the transfer pricing is required to be made. We'll talk about the secondary adjustment in the coming slides. Moving on to the next amendment, a small amendment in ITR 5 and 6. up to assessment year 1920, there was no requirement to intimate separate computation of income from life insurance business. From the current assessment year, another column and a few columns have been added in Schedule PP, wherein the taxpayer is required to denote the separate computation of income if that business pertains to the life insurance business, and if the income is chargeable to tax under Section 115B. The taxpayer is required to denote the net profit addition, deductions, and net total income in Schedule PP. Moving on to a very important amendment as far as capital gains is concerned. This amendment is made in ITR forms 2, 3, 5, and 6. Now, as we all know that Section 112A, which deals with taxability of long-term capital gains arising on sale of listed equity shares or listed units of equity-oriented mutual fund. These the long-term capital gain was made chargeable to tax at 10% from 1st of April 2019, and hence this amendment was effective for assessment year 1920 also. Now, when the ITR forms for assessment year 1920 were notified originally, this specific schedule was not inserted in those forms. Later on, when the Income Tax Department came up with the online filing utilities on the portal, this schedule was inserted in those ITR forms. Later on, the Tax Department clarified that Schedule 112A would not be mandatory for assessment year 1920. It is an optional schedule for all the taxpayers, and the taxpayer could either report the long-term capital gain in Schedule Capital Gain itself or in Schedule 112A. Moving on to the current assessment year 2021, this Schedule 112A has been made mandatory, and now the taxpayer is compulsorily required to report the long-term capital gain details script-wise. The taxpayer is required to denote the ISIN code of each and every script or the unit, the name, the number of shares or units held, the sale price, cost of acquisition, so on and so forth. Of course, this would lead to very cumbersome reporting requirements, and those dealing in share transactions are probably required to keep all the transactions relating to their share transactions in detail, so that the tax professionals like us are able to fill this schedule properly. Section 112A was applicable to resident taxpayers. Similarly, Section 115AD is applicable to non-residents. Similar sort of reporting details are required even for non-resident taxpayers. And now this schedule is made mandatory from the current assessment year, which is assessment year 2021. Moving on to the next set of amendments, for capital gains. Now, the rates of surcharge were enhanced by Finance Act number 2 of 2019, whereby two additional surcharge rates of 25% and 37% were introduced. After these amendments were made, there was a lot of concerns which were raised by the foreign investors. To address those concerns, the additional surcharge rates of 25% and 37% were withdrawn on individual HUFs, AOP, and BOI, but they were withdrawn only in respect of certain incomes. Such as short-term capital gain or long-term capital gain earned under Section 111A or 112A. The additional surcharge rates of 25% and 37% were made inapplicable to these streams of income, but for the balance income, they were made applicable. To enable or to incorporate all these amendments, certain columns have been added under the head surcharge in Schedule Part B, which talks about the computation of tax liability. Now, 3 columns have been added under the head surcharge. Firstly, the first column talks about applicability of surcharge rate at the rate of 25% in case the taxpayer has an income under Section 68 to 69D. Column number 2 talks about surcharge rate of 10% or 15% if the income of a person is up to 2 crores, or maybe if the person has earned short-term capital gain or long-term capital gain under Section 111A or 112A. And lastly, the third column is applicable for all the balance sets of income, where even the enhanced rates of 25% and 37% would be applicable. Moving on to the next set of head, income from other sources, very small amendment as far as ITR 6 is concerned. If a domestic company is receiving a dividend income from a foreign company, which is taxable under section 115 BBD, now separate disclosure is required under Schedule OS as well as Schedule SI. A very small amendment in ITR Form 6. Similarly, if a foreign company is receiving any sort of an FTS income, which is fees for technical services, or a royalty income, which is chargeable to tax at the rate of 50%, then that company is required to make separate disclosure in ITR Form 6, and new columns have been added for such disclosure. These are very small amendments. Moving on to the next set of amendments, which pertains to deductions under Chapter 6A. Firstly, a new schedule, Section 80D, has been inserted in ITR Forms 1, 2, 3, and 4, wherein now the taxpayer is required to give out certain additional disclosures. Firstly, the taxpayer is required to intimate whether the taxpayer himself or any of his family member is a senior citizen. Secondly, whether any of the parents of the taxpayer is a senior citizen. Thereon, the taxpayer is required to intimate the premiums paid under various subheads, which could be health insurance or maybe preventive health checkup and so on. And finally, the eligible amount which is eligible to be claimed under Section 80D would be derived. Next would be certain necessary fields have been added to enable the taxpayer to claim various deductions under Chapter 6A. Firstly, another column has been inserted to claim deduction under Section 80EA and 80EB, which talks about deduction of interest on loan taken to buy a new house, or maybe if any interest is paid to acquire an electrical vehicle. These columns have been inserted in ITR Forms 1, 2, 3, and 4. Secondly, new column has been added to claim deduction under Section 80LA. This deduction could be claimed only in ITR Forms 5 and 6. And lastly, another column has been inserted to enable companies to claim deduction under Section 80PA, which talks about deductions available to a producer company. Moving on to the next bucket, which talks about the pass-through income. A very important amendment as far as pass-through entities is concerned. Now, the Income Tax Act provides pass-through status to a few entities like the Real Estate Investment Trust, the Infrastructure Investment Trust, Category 1 or Category 2 AIFs. These entities are allowed to pass through their income to the investors, and the tax is charged not at the level of the entity, but tax is charged at the hands of the investor. When any income is passed through from the entity to the investors, the investor is required to pay tax on that income as if he had directly invested in those funds. Now, Finance Act 2020 has made a small amendment in Section 115 UB to provide that along with income, certain entities are also allowed to pass through their losses to the investors. And hence, to enable or to incorporate these amendments, certain columns have been inserted in Schedule PTI, and now the taxpayer is required to denote under which section is the entity or the investment trust registered. It could be either under 115 UA or 115 UB. Secondly, the taxpayer is now required to denote the exact amount of loss which has been given by the fund to that investor, and if any loss has been passed to that investor, the taxpayer is allowed to set off that loss against any other income. Similar amendments are also made in Schedule CFL, which talks about the carry forward of losses. Certain columns have been added under the head house property loss, short-term capital loss, or the long-term capital loss. Now the taxpayer has been given an option to intimate the loss which has been passed through from the investment trust or the real estate investment trust, and if that loss is required to be carried forward to subsequent assessment years, that loss is required to be reported in Schedule CFL itself. This amendment is made in ITR forms 2, 3, 5, 6 and 7. Moving on to the next bucket, which talks about the transfer pricing provisions. It talks about secondary adjustment. Now, the concept of secondary adjustment was introduced by Finance Act 2017, and then Section 92CE was inserted to provide that in case of certain primary adjustments, if it leads to increase in income or reduction in loss of a taxpayer, then for a certain specific transactions, the taxpayer is required to make secondary adjustments. This secondary adjustment is required to be made if certain excess amount is repatriated to the associated enterprise. Let's understand these provisions with the help of an example. Suppose an Indian company remits an amount of 1 crore to its associated enterprise in Singapore as interest, and the Indian company has remitted an amount of 1 crore. Now, the arm's length price of this transaction comes out to rupees 80 lakhs, meaning the Indian company has repatriated 20 lakhs in excess to the associated enterprise. Now, this Section 92CE states that the excess money of rupees 20 lakhs, which is lying with the associated enterprise, that money is required to be repatriated back to India within certain specified time. And if that amount is not repatriated back to India, it would be construed as an advance given to the associated enterprise, and the Indian company is required to accrue interest income on that advance. These were the provisions contained in Section 92CE. Finance Act 2019 made another small amendment in this Section 92CE, whereby now the Indian company has been given an option to pay an additional income tax at the rate of 18% on the excess money which is lying with the associated enterprise. And if the Indian company pays this additional income tax, then those funds are not required to be repatriated back to India. To incorporate all these amendments, this Schedule TPSA has been introduced in ITR forms 3, 5 and 6. And now the taxpayer is required to intimate the amount of the primary adjustment which is made. Secondly, the excess money which is lying with the associated enterprises. Thirdly, the additional income tax at the rate of 18% if the Indian company is paying. And lastly, the reporting details as far as the tax payment is concerned. Moving on to certain specific changes in ITR forms 6 and 7. Firstly, ITR 6. As Kinjal highlighted, now for assessment year 2021, there are alternative taxation regimes which are available to all the companies. And now an additional column has been inserted in ITR form 6. And now the company is required to denote whether any of the alternative taxation regimes are being opted for. The company is required to select yes or no against any of these sections. An important thing to be kept in mind here is if the Indian company wishes to claim the alternative taxation regimes under Section 115BA or BAA or BAB, the Indian company is mandatorily required firstly to exercise that option to claim the available taxation regime. How can a company exercise the option? It can be exercised only by furnishing the information in particular forms. The CBDT has notified 3 forms. Firstly, form number 10IB, which would be applicable for 115BA. Second form is 10IC and 10ID for 115BAA and BAB. These forms are required to be furnished only in year 1. Subsequently, if the option is selected, it would be made applicable to all subsequent years. And if the option is to be, exercised, it has to be exercised prior to filing of your return, or it is to be furnished on or before the due date for filing return. This amendment is very important for assessment in 2021 because these 2 particular sections, 115BAA and BAB, are made applicable for the first time for the current assessment year. And mind you, for Section 115BAB, if a newly incorporated company does not claim the benefit of this section in year 1, it would not be applicable in the subsequent assessment years. Moving on to the next amendment as far as general information in ITR 6 is concerned. Now, up to assessment year 1920, only a managing director of a company could sign and verify the income tax return forms. If the managing director was not available, or he, maybe because of certain reason he is not able to verify, any other director could sign or verify the ITR form. From assessment year 2021, it is being amended and to provide that any person who is authorized by the board of directors could sign and verify the income tax return. To incorporate this amendment, certain changes are made in general information, and now the company is required to intimate the name, the designation, the address of the person who is verifying the return, the PAN or the Aadhaar number, as well as the document identification number if available of the person who is signing or verifying the ITR form. Next amendment pertains to Schedule SH1, which talks about shareholding of unlisted companies. Now, this schedule has been made inapplicable to companies which are registered under Section 8 of the Companies Act or companies which are limited by guarantee. A very small amendment. Moving on to the amendments in ITR Form 7, which is applicable for charitable trust or registered trust, political parties. Now, as we all know, Finance Act 2020 has made enormous changes as far as taxability of charitable trust is concerned. A new Section 12AB has been inserted, which to replace the erstwhile or the old Section 12AA. The new section states that all the existing registered charitable trusts who are registered under Section 12AA are required to re-register themselves under this new Section 12AB. Similar amendments were made in sections 80G as well as 1023C, and the original effective date to get the trust re-registered was 1st of June 2020. Owing to the pandemic, this date of 1st of June 2020 was pushed to 1st of October, and now all the charitable trusts are required to re-register themselves within 3 months from 1st of October, which is from 1st of October to 31st December. To enable or to incorporate all these amendments, certain columns have been added in Schedule General Information in ITR 7, and now the charitable trust is required to report whether an application for registration is made as per the new provisions. The trust is required to report the yes or no under this column. Secondly, the trust is required to intimate the section under which registration is applied. Thirdly, the date on which application was made or approved. And lastly, the section of exemption the trust wishes to claim under the various provisions. It could be either under Section 12AB or maybe under Section 2023C. And probably we could see certain cases where the charitable trust files the ITR form ITR 7 probably by 30th November, because the due date for filing income tax return form is extended up to 30th November. However, that trust has not made an application to re-register themselves under the new provisions. In those cases, probably these columns would remain blank, and hopefully it does not lead to problems while processing of the returns. Moving on to the next set of amendments in Schedule ER. Now, this Schedule ER is applicable to those charitable trusts who are claiming exemption under Section 11 or under Section 1023C. The trust is required to intimate the various revenue expenditures or various amounts which are applied towards the objects of the trust. Now, if a charitable trust registered under Section 12AA gives a corpus donation to another charitable trust who is also registered under Section 12AA, then this corpus donation is not allowed as an amount which is applied towards the objects of the trust. In short, it is a disallowable expenditure. And hence, to enable reporting of such disallowances, a column has been added in Schedule ER where if the trust has given a corpus donation, that amount is required to be intimated in this specific column. The next set of amendment pertains to Schedule Capital Gain, a very small amendment. Up to assessment in 1920, the charitable trust was given an option to probably report details or income if there was if any exemption was claimed under 112A or any other section apart from 11(1). Now the income tax department has realized that if a trust is being regulated by the section 11, 12 or 13, which are in a code in itself, then the other available exemptions are not applicable to that trust, and hence these specific columns have been deleted for the current assessment year 2021. Similarly, certain columns which were there in the earlier assessment year have been discontinued for the current year, which were income chargeable to tax at specific rates under section 115B. These all sections are no more applicable to charitable trust, and hence these columns have been removed from ITR 7. Another interesting amendment as far as ITR V acknowledgement is concerned, I'm sure those who have filed the ITR forms for this year would have realized that when the income tax return is being uploaded on the portal, the normal ITR V is not generated, but this proforma or this receipt kind of thing is generated, where it states that the income tax return has been uploaded, but once you e-verify or you successfully verify your tax return, the ITR V acknowledgement would be generated. So this is the proforma which is being generated once the income tax return is being uploaded on the portal. Once you e-verify the return, the normal ITR V acknowledgement is generated. This facility is inserted so that the problem of verification of returns is not faced by the tax department. And lastly, those taxpayers who are not using any tax softwares to compute their to make their tax computations or to file their tax returns, a very useful utility is available on the income tax portal, which is the pre-XML file. You need to just log into your account, and under My Account there is an option of downloading pre-XML file. If you download this XML file and if you import the XML file into the utility, all the incomes and the tax credits which are appearing in the form 26AS gets directly reported in the income tax return itself. A very useful utility, and I'm sure most of us can avail this facility available on the portal. Moving on to the next head, relevance of efficient reporting, Kinjal would highlight on this topic.
Yeah, thanks, Vishesh. So I think we'll just take another 5 minutes of yours to sum up this session. And this is by far the most important slide, I would say, apart from all the specific changes. Because right now, starting with why it is relevant, obviously efficient reporting is always relevant in all the years, but why it is more relevant from this year and the years to come is that we all know that faceless assessments have now become mandatory. Now they are also introducing faceless appeals. So the entire there is a entire paradigm shift in the way they are processing the returns of income, the way they are conducting proceedings. And as I always say, that the first step of litigation is the income tax return which the assessee files, because those are the details which are foremost given by the assessee to the income tax department, and hence it is more and more relevant to reduce the errors which are there, because it may not be perceived as an error, but it may also be perceived as something intentional, which is missed or which is not given correctly. So they are behind increasing the tax base. This they have showed, the government has showed this with their intentions time and again. And that is the reason we need to see that all those assessors, if we are CAs or tax return preparers or tax accountants, then all those assessees who are not filing return of income up till now, and they are now coming into the purview, then it is a necessity to file those returns, because non-filing is going to have a very huge repercussions, because as we know the intention of the government. So that is first and foremost. As Vishesh has concluded, and the first slide which he had mentioned was regarding the applicability of the income tax return form. I think it is very important also to see that the correct return form is chosen, because if a wrong return form is by mistake, if that is chosen, then the entire process further is going to get complicated. one of the most important development which the income tax department has successfully achieved is linking their database with database of all other departments. Whether you may take SEBI or you may take MCA, which is corporate law, or GST, or even for that matter custom authorities. So they are very nicely interlinking the data which they are receiving from other departments, their packs which they are signing with other departments, and obviously we know that they are using the best of technology. They are working right now on artificial intelligence and machine learning. So linking information and bringing out queries is going to be a very easy and a very good task for the department. So it is very important for an assessee while filing the income tax return form itself, to see that they are at par with the details which they are submitting at other places elsewhere. So this is why this is relevant, is that sometimes it may happen that it is not possible for an assessee to link or to have similar details in GST or income tax. The turnover may not match, so there may be a lot of discrepancies which may happen, but one should have the reason why there is a discrepancy. So before filing income tax return form also, we have to keep in mind not only income tax but all other things as well, all other laws as well. And that is very important because they have become smarter, and that is why our scope of making errors is has to reduce to zero. We all know that there are penal consequences, there is prosecution, there is a new section which was inserted for penalty, which replaced the age old section of 271(1)(c). Now we have 270A, wherein they levy penalty for misreporting and underreporting of income. So this will start right from the return form itself, and hence because of that new section also, it is very relevant. Apart from that, there are certain do's and don'ts which one needs to keep in mind. First thing is blind reliance on any tax return softwares is to be deleted, because they are not completely error free. There are errors which are made by the softwares also. So please, if there is a confusion, go to the income tax database software itself and try to verify whether that is also showing the same tax impact or not. So in case of any of those kind of confusions, try to cross verify. Do not blindly rely on the tax return softwares. Apply your brains before that. Always have a maker checker system, since we have seen since last 2 hours that there are multiple amendments in the forms and other amendments. One needs to be careful that what all is submitted is correct. It is very difficult when we are doing mass filing of returns to pay attention to intricate details. So always check the forms which are made by our articles or our assistants, because they are also not aware. And as I mentioned, when I was mentioning about the faceless assessments and schemes, they have also started verifications. So in July, end of the July, they had brought about the verifications, wherein they were calling for information and they were asking whether you have filed return or not, why you have not filed, and if there are any discrepancies, there is any underreporting. So this is also another way in which they are bringing out inquiries. So this is also one of the reason why one needs to be careful. One has to be very careful in also reporting the exempt income, and reporting all those incomes which are not mandatory per se. So even if you do not file, the income tax authorities at that point of time will not come to know whether you should file or not. Maybe at a later date after investigation, they may feel that you have not reported certain details. So all disclosure related information which are relevant, which you have, and even the exempt income, you should report. You should not skip on reporting any that kind of information. I'll just quote one simple example which has happened in the practical life. A senior citizen having a huge retirement fund has invested a lot of amount in shares, has taken a huge flat, and majority of the income of that senior citizen was exempt income earlier, when dividend was exempt. And other bond related interest, he used to not show that income and used to not file the income tax return itself, or else file the return and just show the normal interest income and just other details. Now the inquiries came up that how he has the source to pay for such investments. Now, if we do not mention those exempt income, how are we going to establish the source? So this is just one simple example, but that is the reason why the form needs to be complete when you file. So please do check it before you finally upload. So these are just a few cents from our side, and we hope that this session would have been have benefited in any little way possible. Thank you all for listening to us, and I think we can move on to queries.
Now it's on your screen. First query is from Mr. Krishan Dev.
Okay.
And he can answer. Purchase of foreign currency under SFT, where to report it?
So purchase of foreign currency will be this under SFT, this transaction, this will be reported by the entity from which you have purchased. So if it is a bank, then the bank itself would have reported under the SFT return, which is filed to the income tax authorities, and that would reflect in your income tax returns. Apart from that, there are foreign asset schedules. So if you have any kind of foreign assets, then those details have to be reported under the foreign asset schedules, provided the person is a resident.
Next query is from Mihir Desai. Will donation done is also shown in 26 AS?
So no, right now, up till now, there is nothing which specifically specifies that donation will be shown. However, as I mentioned earlier, that all specified financial transactions will come. So if the donation is made beyond the prescribed limit in cash, then it will reflect in the specified financial transaction. In turn, it will get reflected in 26 years. But there is no specific amendment as respect to showing or disclosing the donations.
So just one point to add over here.
Yes,
when the re-registration process of the charitable trust is done, after that there is another set of kind of an AI return or maybe TDS return, which would be made mandatory to all the charitable trust to intimate all the donee details. After that form is being made mandatory to all the charitable trust, then the donation details would be reported in 26 years, not before that.
Next query is from interest unpaid to credit cooperative society, covered under section 43B.
I think interest unpaid. So I'm not understanding the query correctly, but whatever I am thinking is correct is that the amendments which were made was regards to NBFC, but 43B allowance or disallowance is completely related to payments, whether it has been so it is, I think, cooperative society banks. If they are there, it will be forming part of the normal banks. So yeah.
Can non-resident person who is holding bank account in his name in India is required to file return of income in India?
If that non-resident taxpayer is having income which exceeds the exemption limit, only then he is required to file the tax return in India. And secondly, if that person wishes to claim any sort of refund, then of course he has to file the ITR form. Otherwise, he is not required to file the form.
Next query is return for 44AD with rental income from 4 property to be filed in which ITR form?
44AD with rental income. So this year again, ITR 2 would be, ITR 3 would be applicable because he's having income from business, and ITR 4 would be applicable only if the person holds only one house property. So since the number of house property exceeds 1, ITR 3 would be applicable over here.
Okay. Next, same query, I think. Can we claim 44AD with turnover of 4.50 crore and cash received payment less than 5%?
So I think section 44AD is applicable only if the turnover is less than 2 crores. So if it is 4.5 crores, then 44AD will definitely not apply. Then if the cash receipts and payments is less than 5%, and since the turnover is less than 5 crores, the assessee will totally go out of tax audit itself under 44AB only.
Okay. Next query is Mr. Arvind Agarwal. When to mention detail of self-acquired property owned jointly or severally?
So this would be applicable only if the income of that person exceeds 50 lakhs, in that case, that person is required to denote all the list of assets under Schedule AL. In that case, he can select and intimate or report the details of the house property, and also mention that it is a single owner, or probably it's a joint owner. And of course, in ITR, in all the ITR forms under income from house property, the taxpayer has an option to disclose the details of self-occupied property. So even in scheduled house property, he can report those details.
Next query: if assessee is earning income through bitcoins, through which head it has to report it? I don't think so. Even Income Tax Act has mentioned this Bitcoin income.
It's not mentioned, but it could either be under, if it's treated as an investment, it could be under capital gains, or if he's trading, then it could be under business.
So whether it's a speculative or other sources or the business.
Absolutely.
Not had decided. If next query is from Vishal Maheshwari: if someone have turnover of 1.5 crore but cash receipts are less than 5%, then he need to get audited his book account. So ये तो query it's not relevant for today. Today is for the ITR. So if you have any question related to ITR, you can ask. Next query is from Parmesh Arya: interest on EPF which is exempted through more than 4 lakh can not be reported because interest is credited after more than 7 months of closing. But what is the query?
What is the query?
So I think he is asking that he is not able to report it. So I think then in such cases, such there are practical difficulties. I think one may choose to not report, and one may choose also not to revise just to show the exempt income, because we know that revision should not be made just to show the exempt income.
Okay. So let's take last query. Please explain more the procedure or way to use pre-file form in XML available at the site used under utility to file return from current assessment year 2021.
Sure. So when you log on to your income tax account on the incometaxindia.gov.in, under the tab My Account, there is an option to download the pre-XML file. When you select that option, it asks which assessment year. You can select assessment year 2021, and then an XML file is downloaded on your computer. Now that XML file is to be imported in the utility which is available. Either it could be a Java utility or the Excel utility. Once you import that XML file, all the information which is there in the 26 AS directly gets translated in your utility itself.
No special deduction are there, I think. Is there any special deduction on COVID?
No, sir. What they are giving is just the extension of deadlines and due dates. That is the benefit they are providing.
Yes, many requests we are getting from PPT. If you people allowed, you can send us the PPT. Then we'll definitely upload into the comment section, because it's the option for the speakers whether they send it or not. Let's take last question.
We send it across.
Cash deposited shown in SFT, should we have considered full as income from business?
So no. So the thing is that one needs to, every cash deposit is not necessarily a business income. So and many a times what happens is that the cash deposit itself, because there are many businesses which work only on cash economy. So it is normally rooted in the tax audit or in the books of accounts, even if it is cash. So I think that we just need to remove from our mind that just because it is cash, it doesn't mean it is illegal or something like that. And second is that cash deposit may also have some other repercussions. So only deposit is not going to be considered. If one is knowing that the cash deposit is something which is an income which is accrued to the assessee without any benefit, then it will come under section 56(2)(10) also, because when something is received from someone without any consideration, then it will form part of 56(2)(10). So in that case, then it will be income from other sources. But if it is something like sales and it is not reported, then it may form part of business income. So one has to choose which head it is depending upon the nature of cash deposits received.
So thank you very much, CA Kinjal Bhuta ji and CA Vishesh Sangoi ji, for such a wonderful presentation. and explaining the provisions related to the changes in the income tax return forms and the amendments related to that for the assessment year 2021. And I hope maximum queries they have solved. So once again, my sincere thanks to you, and we'll call you some other day on some other topic. Once again, my sincere thanks to you. Thank you very much for both of you.
Thank you so much. Thank you.